Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 10, the Group B exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. You get the application aspect wrong, that is one thing, and it is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so we're on 43 here. And it says balance sheet disclosure. All right, this is the following information. The selected account balances as January 31st. Right, prepare the stockholders' equity section of the company's balance sheet. All right, again, all right, I'm not going to, oops, I wanted to make it smaller. There we go. I'm not going to make this pretty, okay? You know, if you want to see pretty, look at the solution, okay? It should be done like the solution, but as long as I understand what I'm doing as far as formatting is concerned, remember, formatting is important. These are professional papers, and people make decisions based upon implications of the formatting. So yes, you do have to pay attention to formatting, and I know the formatting. All right, I know to make underlines, double underlines, blah 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 blah, how to add, subtract. And if you watched the last video, I disagreed with the way the authors presented the negative 26,000, right? Because of the implications. So you know, pay attention to the formatting, but in sitting here as if I was doing this in homework, I'm taking shortcuts and liberties all over the place here, okay? In order to, because I don't want to spend a ton of time doing this, all right? All right, so get my pen here. So I'm going to have, you know, my equity here, equity section of the balance sheet, and then I'm going to have paid in capital. All right, first thing I need to look at here is preferred stock right there, right? So I have preferred stock, and it is at 7%. So I'm just kind of reproducing what's here. 7%, $12 par, 20,000 shares authorized, and then 10,000 shares issued, 10,000, and I don't have too much space here. If I had a great big sheet of paper, it'd be a little bit easier. Shares issued and outstanding, and that total value is 120,000. Okay, so the next I look at common, and I'm just reproducing that also. So common stock, no par, $8 stated value, uh, 50,000 shares authorized, issued, and outstanding. And the total value of that is 400,000. And then I have to think about paid in capital, right? So I have only one account, which is called paid in capital in excess of stated value, which is common for the common stock, and that amount is 65,000. So my total paid in capital is $585,000. And then I have, let's see, do I have treasury stock? No. Okay, don't need depreciation, inventory, nope, nope, nope. So all I'm left with is the retained earnings. So I have retained earnings of 123,000. So my total stockholders' equity is $708,000, double underline. Okay, $, double underline. So that's kind of it. You know, you basically, you know, I say don't mimic, you know, the work that's in the book. You know, it's better to understand the concepts and then apply that understanding to the situation. And as you saw, that's what I did here. Okay. I had an understanding that I start out with paid in capital, and then I go down. I think about preferred. If I had paid in capital for preferred, that would paid in capital in excess, I should say, for the preferred, it would, you know, go right in there. But we don't have it, so I don't need it. Then I look at my common stock, and then I look at paid in capital for my common stock. Then I have my total of the paid in capital. Then I I add in my retained earnings, and then I would have to consider treasury stock. If I had treasury stock, that would go like right in here. So that's kind of like the structure of the equity section of the balance sheet, right? And that's the concept. And I'm working through that concept in my mind as I create this, right? Now, you know, I warn against mimicking. Yes, a lot of times, as long as you have that framework in your mind, preferred stock, common stock. Let me do it like this. Let me do it like this. So if I have preferred stock and then paid in capital, and I have common stock paid in capital, and then I have total, and then I have retained earnings, and then I have treasury stock, and then my total stockholders' equity. As long as I understand this structure, okay, I can actually go back and mimic and copy. You know, if you went back to the previous slide, you know, that's, you know, the previous exercise, you know, that's what we're looking at right here, okay? I mean, that's the structure, that's the way it needs to be created, and you can mimic this, but just realize, depending upon the situation or the particular problem, you know, you're going to have variations to it, and depending upon the variations, you're going to have to take that into consideration. But for the most part, you basically just saw me recopying this information that's already presented right here. So this type of work, you know, in creating the equity section shouldn't be that difficult. The only thing you have to do is just pay attention to those variations, and that's why I said, if you understand the theory when it comes to the you know, stocks and dividends and things like that, if you understand the overall concept, you know, that's great, but just realize that every situation is different. You're going to have these variations. Well, you can sort of mimic what you're looking at, but just make sure that you take into consideration those variations. If you're looking at, you know, if you were looking at this right here, okay, if you're looking at this right here, and as you saw, you know, I had to take into consideration treasury stock. Well, then obviously I can't just copy this word for word. I have to add in the treasury stock. All right. I hope that made sense. And if not, then, you know, feel free, you know, go back and watch the theory videos, do the exercises, because this is one of these things where the more exercises you do, the better you get at it, and you get to, you know what changes to make because you've experienced those changes before. Okay, even though every situation may be new, they're very, very similar. All right. So with that, and if you still don't get it, you know, feel free to telephone and speak with an instructor. Okay. And I'll see you in the next video for the next problem.